Very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. I'm looking forward to taking us through the next half hour or so as we look at the dominant currency sentiment pair that I've chosen for today, and we look at what's happening in the market generally. So just to make it clear that as we're talking about different entries, exit levels, different currency pairs, commodities, this is not a advocation for buying or selling. It's an educational webinar where you see how myself, as someone with a professional trading background, goes about understanding the market. So that's the whole idea of this educational webinar. In terms of looking what we are going through, if you look at your handouts, there is a handout panel. There's two of them. There's a central bank overview and the workshop handout. If you open the workshop handout, you will see here a analysis of the 5 key principles I'll be looking at through the session. And we'll be looking at these 5 principles in order to ascertain which is the high probability currency pair for trading. You can print this out and leave it by your trading desk to help you with your analysis. Now, other key areas we're looking at, a special topic I'm looking at today is how to trade off market expectations on scheduled data points. So what I'll show you is how the market goes about interpreting data as it's about to be released and as it is released. I'll show you a couple of tricks you can use about trading off market expectations, and we'll use a couple of examples coming out for tomorrow in order to help us see how that works in practice. If you're just joining us, a very warm welcome, and I look forward to taking us through to the next steps. If you've got any suggestions for topics, please email me here, giles.cochran@hycm.com, and you know, if there's anything I can help you with, I will try to help you. Don't forget, we'll be looking at trade ideas at the end of the session. So any trade ideas you have, just save them up and then you can ask them in the question and answer panel, which is on your GoToWebinar control panel. There's a little box that says questions, and if you just type your questions for any currency pair you want me to look at, or any other general trading question you have, please feel free to ask questions away. And I hope that is a helpful service for you. Before we get going, don't forget to turn to your handout. And the first thing we do before we start looking at the market is looking back. So I think it's just a moment pausing to see where we are with the markets, particularly because markets have been very, very choppy recently. I just want to go through some of the reasons for the choppy markets. We can see quite a lot of range-bound action in the markets today, and there's 2 main narratives that are really driving the market. Number one, it's the virus fears. So just taking a look at the increase in COVID-19 cases, you can just see, look, globally, the number of COVID-19 cases are continually rising, and there's a number of different places now which are really in the grip of a second wave. You think of the US and the amount of new cases there are in the US, it definitely is a second wave outbreak for the US. And the market is really torn because it can't quite put to bed the coronavirus epidemic. Now, with over 25 companies working on treatment or a cure for COVID-19, the bottom line is that the market is expecting a cure or a treatment for coronavirus by the end of this year or by the start of next year. That's what the market is sort of pricing in. And that goes some way to explain this huge recovery we've seen off March's lows. This is the S&P 500. And you can see that the S&P 500, alongside other major stocks, when this fell, we saw this very large recovery of, you know, nearly back up to pre-COVID-19 levels. So we have seen this huge, you know, recovery in global stocks. Now, the reason for this is the hope that this is a V-shaped recovery, that the COVID-19, you know, pandemic is going to be just a blip. It's going to have a short, sharp effect. So that's what the market's really pricing in and hoping. Now, the concern is that these recovery hopes don't materialize. So the bearish case is that, okay, we have had this large recovery in stocks, but as soon as future earnings and as soon as the government's furlough schemes end, we're going to see a whole wave of job losses. And with all the wave of job losses, we're not going to have individuals able to support the economy in the same way. So we're going to see companies losing value, and we're going to see global stocks fall back down towards testing March lows. That's the bearish case. The bullish case says, no, we've got lots of Federal Reserve stimulus, we've got government stimulus, there will be enough stimulus to keep the economies going, and any retracement in the stocks is just a buy on the dips. So that's the two kind of competing narratives. So at the moment today, what we've been looking at, we've just been seeing this really, static market, very flat ranges. You can see here in the major pairs, look how static they are, just these tight ranges, maybe a 20 or 30 point range in a number of the different major pairs. Dollar index not really going very far. And this is because of that. Okay, which narrative does the market focus on? The virus fears or the recovery hopes? So if you've been struggling in trading these markets, don't be alarmed. That's quite normal. It's very choppy price action, and there is without clear direction. And we've continually seen risk on, risk off trading alternating even within the same day. Sometimes a couple of changes in the session, like yesterday was a good example. We saw yesterday that the market started off risk off and then was ending the day with a more risk on bias. So you can see that in the Aussie US dollar currency pair yesterday, it started off risk off, but then recovered risk on. I was doing an interview for CNBC Arabia, and we were talking about why is that happening? And it's simply because of these two competing narratives, virus fears versus the hopes of an economic recovery, and they keep sort of playing off each other. That's really what's going on in this environment. So I was looking today, what's usually, we'll go back to the main screen, what I like to do, for those of you who are aware, I usually like to look at the whole idea of trading is you want to bank a strong currency against a weak currency. Just like if you have a strong arm, you'd want to have a strong arm wrestler against a weak arm wrestler to be sure of victory. So in the same way, in order to find a high probability currency pair to trade, you want to trade a strong currency versus a weak currency. That's what we're kind of looking at doing. And normally on these webinars on Wednesdays, I like to do these on a one-to-one basis. In other words, a basis on which the currency pair is for intraday trading, rather. It's an intraday currency pair for trading in the session. At the moment, the market is just so ambivalent, it's so flat. There isn't really a key currency pair to be looking at for an intraday trade. So I wanted to look at a swing trade outlook that uses exactly the same principle, and it's quite helpful because by using this principle, you can develop your own trading strategy and style, and particularly over a longer time frame, which can be helpful if you work a regular job, if you are not able to access the charts on a day-to-day basis. So the first thing to look at is the weak currency. Now, looking at Australia, what we see is that Australia has been forced to go back into lockdown measures as COVID-19 cases start to rise in Australia's second most populous state of Victoria. Now, I'm just going to quickly show you some of those rises. I'm going to go back to screen 2, and you can see here that this is the daily count of new COVID-19 cases. You can see, look, coming into the recent past, you can see how much there's been a second spike in Australia, and those cases are far greater than the original wave. So we're seeing this second wave phenomena in Australia. So this is Victoria. It's the second most populous state in Australia, over 6 million people includes the metropolis area of Melbourne. So it is a significant area and a significant thing to be aware of. So this is likely to be weighing on the Australian dollar medium term. Now, the Australian dollar is obviously a risk currency. So when risk is on, we see the Australian dollar rise. So any weakness will be made worse if we see risk off trading. So any concerns about COVID-19 cases, any US-China trade issues, anything like that will also weaken the Australian dollar. Now, by contrast, if we contrast this, Europe has falling COVID-19 cases, and what we have is we have Germany's COVID-19 threshold remains below the key threshold of 1. That's the R rate, the rate of infection. So in other words, for every person that's infected, at the moment, less than one other person is being infected. That means the whole impact of the virus is shrinking. Now, Europe also has this huge spending PEP program, over 1 trillion, I think it's 1.35 trillion euros. It also has this proposed recovery fund of 750 billion euros. Some of it is in grants and some of it is in loans. And the idea is that the EU wants to support its most struggling EU members. Italy, Greece, Spain, they stand to benefit from this recovery fund. And next week, 17th to 18th, European leaders will be meeting to potentially authorize what could be a huge stimulus package. So although this package has not been signaled, although the package has been well signaled, it's not fully priced in. So you can see a case for Euro Australian longs, because we're expecting weakness in the Australian dollar due to the lockdown measures. 6 weeks the Victoria State is undergoing lockdown measures for, but that's take us to the middle of August. And the euro should be supported on hopes of the proposed recovery fund. So therefore, we would potentially expect euro Australian dollar longs from market. Now, what are the risks to this trading outlook? Well, we'll look at the risks. The risks first and foremost here is if European Recovery Fund is rejected by the so-called Frugal Four, this will weaken the euro and invalidate this outlook. Now, the Frugal Four are the countries of Austria, Sweden, Denmark, and Netherlands. They are opposed to the giving of grants to a number of the European countries. So as a result of that, there's concerns that these 4 countries, and there's a 5th country that's also got concerns as well, that's the country of Finland, they could veto the recovery fund. They could say, we don't like it and we're not prepared to vote it through. The recovery fund needs the votes of all member states, 27 odd member states in the European Union, and just one of them can veto the decision. So the risk to this euro Australian dollar long is if someone rejects the European Recovery Fund, someone from the Eurozone, and any fast fall in Australia COVID-19 cases would also invalidate this outlook. In other words, if there was like a good understanding that Australian cases were falling and Australia got back under control, that would invalidate this outlook. So that is the swing trade idea. Now let's look potentially where we could look for our entries, exits, and stops. So I'm just going to go over to the screen here, and you should see here the euro Australian dollar currency pair. Now let's look where to put our stops. So first of all, let's just draw a trend line. We can see that we have here a very recent trend line that has got, okay. So you can see we got 1, 2, 3 touches of that trend line. So that's a valid trend line. You could also draw the trend line, from down anywhere down here to there, here to there. That's a valid trend line. So by and large, that's roughly, you can see this ascending trend line. So that would mean that if this outlook remains correct, we would expect price to stay above this trend line. if this analysis is correct. Now, how might we enter then? Well, there's three different ways we might enter here. And we can enter in, sometimes you can enter in on a conformational break. So you can see here's the daily chart. We could do another trend line, and you can see this recent trend line here, just coming across there. So here, we might say, well, look, we would like to enter on a break of this ascending trend line. So you could potentially buy on stop at the 163.70 region. And then a good place to put our stops might be just somewhere right down here below at the 1.5700 region, which gives us plenty of space in case there's a false break of this trend line. The other way of playing this is you could say, well, you know, this is a triangle, an ascending triangle. I'll buy on stop, and I'll keep my stop loss just below the triangular formation here, and I'll look to see how far the price goes heading into next week's European Recovery Fund. So the other option is to buy at market with stops just running below here, and you think, well, if price breaks through here and closes below this area, I'll just take the loss and remove my stop and remove the position, and then enter again on a re-entry back into the pattern. So there's some ways of potentially considering entering there. Any obvious targets? Obvious target would be back up towards this 1.700 region. Although I'd be inclined to see if you could let this run a little bit, depending on what the European Recovery Fund does. So if there is a good boost from the Eurozone and cases of COVID-19 and shutdowns continue in Australia, then we expect more of this Euro Australian dollar upside. So that's one way of looking at this Euro Australian dollar currency pair. Just using this pattern as a tool for stops would be helpful. Probably the best method is buying on stop at 1.6360, stop loss at 1.6060, then looking at an extension of this move down here, so from 1.6800 roughly to 1.6058, so about 700 points. They're looking for about 700 points higher up to that 1.700 level, just looking at taking profit below maybe 16950. That would make sense on that technical perspective. So that's just a little rundown on the Euro Australian dollar currency pair. So what we're going to do now is we're going to now look at key events. So we've looked at the risks, we've gone through the risks to the outlook. These are the major risks, okay? So that's the major risk to be aware of. And the way you play this is that if you suddenly see the European Recovery Fund being rejected, you would just close the position. You don't need to wait for your position to have the stop loss hit. Similarly, if you start to see Australia recovering, you just close the position, because this is based on that principle of strength versus weakness. Okay, looking forward at key events. I'm also going to cover how to trade scheduled data. So we're pretty quiet now for scheduled events for the rest of the session. The main event we had is the unscheduled event from the UK with the UK Finance Minister, our Chancellor of Exchequer, releasing his plans for the mini budget for the UK. And most of those plans that he's used have been expected. And we've seen pretty muted reaction in the pound. So you can see here, pounds, not really moving very far on the announcement. Most of it was expected, wasn't many surprises. So the pound does have a bias to the downside, obviously because of Brexit concerns, the ongoing concerns about Brexit, ongoing concerns about the amount of debt that the UK is increasingly getting in order to pay for this fiscal stimulus. This is all pushing the pound to the downside medium term, just to be aware of that. So wouldn't be surprised if we saw more falls in the pound, but just have to be sensitive at the moment, because the market is moving in ways that aren't always expected, particularly with the pound, but the bias has been to the downside. Now, looking at key events coming forward, we can see that coming forward for the rest of the session, there isn't very much at all in the US session coming up. We do have the weekly crude stocks that are expected to be announced, and it's a draw of 3.1 million. That's what's expected. And obviously the surprise would be anything that is below or above these levels. So the minimum expectation is a draw of 5 million barrels. That would be more bullish for oil. If there's a build of a crude stocks of 1.47, so anything 1.5 million or above would be bullish. That would be bearish for oil, because it would show an increase in inventory levels. So that's what we got coming up. Now, I want to show you how to use these scheduled news events and how traders can use them. But I'm not going to use the weekly crude stocks because it's a little bit more complicated and it's not the easiest example to use. So I'm going to use an example we've got coming out tomorrow, which is the initial jobless claims. This is a helpful metric to use, as well as the continued jobless claims. So this is the US metric, and it's important at the moment because employment is very important at the moment in terms of judging how economies are doing. So it's obvious that that's going to be a key focus. So initial jobless claims is how many people are making a new claim for being out of work. Okay, at the moment it's 1.37 million people are expected. 1.42 million made a claim last week. This happens each week, these jobless claims. So this large uptick in unemployment will be viewed by the market as an indicator of what's going to be happening with jobs in the future. If this figure, you can see here that this figure, if you look at on a chart, for the last few weeks since the coronavirus outbreak, it's just been getting lower each week. So this expected reading of 1.37 million, that's what's expected, okay? There's nothing unusual about that. But you see here the minimum and maximum expectation. This is when you potentially see a market move, because the maximum reading is 1.9 million. If that reading comes in above 1.9 million, it means that even more people are making a jobless claim. So even more people are out of work, which would be a big negative for the US economy. And that would likely turn the market into a risk-off mood. So the way you would use these economic calendar reports is you look what's expected, then you look at the minimum and the maximum expectations. You also at the same time have continued jobless claims. Now what this is arguably more helpful because it shows you how many people in total are out of work. And now that's far more helpful. You'd expect less and less people to be initially claiming for joblessness because obviously as the virus goes on, it is less and less of a surprise. But the important thing is how many people as a whole are out of work. And at the moment, the continued jobless claims is 19.29 million. So if that comes in above 19.8 million, so that comes in at 20 plus million, that would be a negative sign for the US because it would show, look, more people are continually claiming joblessness. There's more people out of work than we thought. That's negative for the economy. So the worst reading tomorrow would be initial jobless claims above 1.9 million and continued jobless claims above 19.8 million. That would tell you, if you saw that, that would tell you, okay, this is a bad data point. We'd expect to see risk off. We'd expect to see S&P 500 fall. We'd expect to see dollar strength, Australian dollar, New Zealand dollar, Canadian dollar weakness, and you can use it to inform your trading decisions. Now, on the other hand, if we saw initial jobless claims below 1.2 million and continued jobless claims below 18.6 million, that would be a bullish signal. That would be good for US stocks. It would also be good for risk, and we'd likely see risk assets rally sharply. So that's how you use expected data points, and it's the same with all the data points that are important. Now, not all these data points are important, but you can see at the moment that joblessness and continued joblessness is a very important metric for the US economy and the state of the global economy as where the US leads, the rest of the world follows. So that shows you how to use that. Just as we come to the end of my presentation before the question and answer session, don't forget we have a number of risks that are just bubbling around in the market at the moment. The EU Recovery Fund, the Frugal Four, we covered that with the Euro-Australian dollar outlook pair, but be aware that that can change market sentiment. And if you suddenly heard a headline saying Frugal Four reject the European Recovery Fund, or European Recovery Fund is dead in the water, and as long as the source was reliable, you'd expect euro weakness. Brexit, we're still here. Any news of a trade deal will be very positive for the pound. Any breakthrough in that, expect pound buying. Got US-China trade tensions. Again, that's been very been bubbling up recently, and not only between US and China, also China-Australia, China-UK, and China-Canada tensions. There's a bit of a narrative starting to develop, like China versus the West. So you just have to watch to see if that narrative becomes something more important. It has the potential to harm risk sentiment if it does. So we need to keep an eye on that. Also got the COVID-19 second wave fears, and these geopolitical tensions from China, India, and Korea are very unlikely to move the market. So I'm going to take them off for now, and they've sort of bubbled back down for recent history. So what trades are you looking at? It'd be great for you to let me know what currency you're looking at, what currency pairs you would like some analysis on. Tell me what are you looking at the moment? So do answer that. Just while you're doing that, I'll just show you a silver, gold. Let me I'm just going to change screens here, silver. So I've been bullish gold for a long time, and I still am bullish gold. So I think looking to buy gold now, if you're not already in, I'm just trying to look for a place to buy. So one place to buy gold, if you're not already in, it's tricky. It's tricky. I'm just trying to see where just having a little look at the different. Let me explain the outlook for gold. First of all, like gold tends to gain when you have a low interest rate environment. With central banks around the world cutting interest rates, a number of central banks have negative interest rates, gold gains value in this environment. So there's a lot of upside for gold at the moment. The only thing to watch out for is if we see a sharp sell-off in equities, then that can hurt the gold market as well. So that's the only thing to be aware of at the moment with the gold market, is that if earnings are bad, if equity markets start falling, we would expect the gold market to fall as well. At the moment, we're heading up towards 1800. Next stop on the charts, we'll be looking at up into this 1900 region. And if we break above this region here, then you can expect gold just to go higher and higher and higher and higher. In terms of where to enter gold from a swing trade perspective, it's a little trickier. So any return back to this level here, 1740, 1750 potentially would be a good area to regain longs. The danger with buying here at the top is that there might be some pullback and you might have to undergo some drawdown. So silver, it's a tricky one to really know how to get into this right now. So one area that I was looking at recently in gold was just breaking out this ascending trend line here. So you might look for similar kind of events. So a gold long that I took was just a break here, was just a break of that trend line, 1, 2, and I just took that as a break. So I would say from here, 1750 is the region to look for a swing trade, is to look to regain gold. So any return back to the 1760, 1750 region, I would say would be a potentially good place to join gold longs. The difficulty with just buying at market is that you may have some drawdown coming out, or we may just move one way up into this 1900 area. That 1900 zone above, that's the obvious target, and we would expect some retracement from gold if we hit there. I hope some of that helps silver. Okay, yeah, how to analyze events which have no numbers associated with them, e.g. trade tensions, and derive the direction in a quantitative way. Okay, Mandar, yeah. When you've got events without any numbers associated, what you want to be looking for is how much of a surprise are those events going to be. So let's take the euro-US dollar pair. Okay, so at the moment, we have expectations that the European Recovery Fund, Mandar, is essentially going to be agreed. There is a little bit of uncertainty, but basically, there's expected to be a compromise and that the European Recovery Fund will be agreed. If it's agreed, it's supported for the euro. So we have some general support for the euro that we can see here, okay? We can also see that price is beginning to consolidate now, as there's a little bit of uncertainty. Next week, Mandar, 17th to 18th July, we have the European Summit, where they will probably decide, or possibly decide, whether they were going to go ahead with the European Recovery Fund. So if they don't, Mandar, and if they say, no, we don't want the European Recovery Fund, we'd expect the euro to sell off. So then you would just be a case of using the technicals in that trade. So, for example, here we can see there's a slight coiling up and a slight kind of triangular pattern, okay? So you can see with this triangular pattern that's just emerging here. See this sort of triangular pattern? A break and a close above could be a trigger. So for instance, Mandar, if for instance the European Recovery Fund is rejected, wait for a break on the daily chart and a close below this level, and that would be an indication that sellers are in control, and you could either sell a retest of this trend line, you could either sell on the break and a close, or if you got the news out early that the European Recovery Fund was rejected, you could sell at market, just pop your stops at the other side of the pattern and go for an extension of one extension length of the pattern and have that as your target. So what you want to look for, Mandar, is you want to be looking for events, and the more unexpected the result, the greater the impact. So a good example in recent history has been the pound, when pound had the Brexit that was totally unexpected. And when we had the unexpected Brexit, you saw how everyone expected the UK to stay within the European Union. And you can see that there was a very sudden, sharp sell-off in the pound, and the pound sold off for 1, 2, 3, 4, 5 months after the EU referendum in 2016. So there's an example. The other thing, Mandar, is just keep coming along to these webinars, and I'll explain it to you as we come up to different events. Okay. Yeah, Don. Yes. What's your take on the pound? It's driving me crazy. Yeah, the pound has been driving me crazy too, Don. So if it's any comfort, do not worry. The pound has been a pain. It just hasn't been reacting the way you'd expect it to. We had where was it? It was yeah, it was mid-June. We had the Bank of England rate meeting, and it was pretty positive, the interest rate meeting. There was no talk of negative interest rates. UK was pretty optimistic on the economy, but yet we saw the pound sell off. We then saw like some really strong retail sales data, pound sold off, some strong PMI data, pound sold off. So there's been this, and then yesterday we saw this sharp move upwards in the pound for literally no reason at all, Don. We were looking at this, and looking for this reason for the upside. Yes, there was dollar weakness yesterday. We did have some risk on trading, but it didn't justify that size of move. There were some Brexit fisheries news out yesterday, but it was nothing new and certainly didn't warrant this large move. And you can see actually price has since retraced, and now the pound is range bound after the EU's mini budget. So for what it's worth, Don, my take on the pound is that it's not making sense much of at all. The big picture, obviously, is these Brexit concerns. So obviously, look, a key area to be looking at on the weekly chart is just looking at this trend line here. So you'd expect to find sellers leaning against that trend line there potentially. So that's just something to be aware of on the weekly chart. I have a bias to sell the pound because of the Brexit concerns, but Don, the pound is not making sense to me. So what I'm waiting for, Don, is something clear, some sentiment that's really clear. It could be something like positive Brexit news, something like that. It really gives the pound a reason to go forward. But at the moment, I'm just neutral on the pound. I got my fingers burnt a couple of times, Don, in the last few months on the pound, so I'm just waiting until it makes a bit more sense. So yeah, I am a little bit confused on the pound as well, Don, so hope that helps. Mandar, you're very welcome. Selva, you're very welcome. Yeah, Dan, you're not the only one. Yeah, it's not responding properly to fundamentals. I would agree. So yeah, you're definitely not the only one, Don. It's sometimes nice to know you have company when things are not acting the way they should be. I did smile as soon as I read your question. Guys, don't forget, come back next week and we can carry on these discussions. Let's see how the pound's doing next week. Selva, let's see how gold's doing next week. Mandar, let's come back next week and look at any events that you want me to run through. And feel free to contact me via my email. It would be great to know anything that you're going to find helpful. That's the questions that I've had for now. Thank you very much for a great session, guys. And don't forget, come back next week. And if you've got any more questions, we'll be looking at those. Oh yeah, Amanda, how to trade at a lower time frame. Okay, lower time frame, what I would do is use a 30-minute charts, Amanda. Use daily pivot points as your support and resistance levels, and use them to take your profit targets. Also have an average directional range and have the ADR high and low of the day marked on the chart. So you know that when prices moves to the ADR high or the low of the day, you know that you are reaching sort of your maximum expectations for that day's profit or that day's loss, okay? Oh, when we have a forecast at a higher time frame, in that case, you can just use trend lines, just like I showed you with the Euro Australian dollar. So we were looking at it from a higher chain from the weekly, and you would look for a break of a trend line to confirm the direction. Just like here, a break of the trend line on the daily chart. We can look at these things in more advanced next time, Mandar, as well. So don't be afraid. Come back and we come back with some more specifics, and we'll look at this more and more. Okay, guys. Thank you very much for a great session, and I look forward to seeing you guys next week. Thank you now. Goodbye.